risk identification. So some of the major risks which come in the examination I have discussed. Other type of risks are also there. Identification should be also done. So those things you can just read it, the book or material. Maybe another 4 or 5 types of risks are there. You just read those things. So next step is risk measurement. After identifying the risk, we have to measure the risk because we want to know how much the impact will be. So that according to that, we have to allocate the capital. We have to maintain that much of capital requirement to offset that loss if at all it happens. The risk measurement procedures are there. So before that, we should know that what are the books or the how the accounting takes place in the bank as per the different type of business we do. So banking business, we know it is about deposit, lending and investment. These are the 3 core business of the banking. And apart from that also, we have, these are within the balance sheet. So we can have some contingent liability or off balance sheet item. Off balance sheet items. Those bank guarantee LC we issue, they are off balance sheet items. So these are the different types of any transaction takes place, either it be deposit transaction.
Powering off.
Any transaction which is made by the bank, it may be a deposit transaction, it may be a loan transaction, or it can be a investment transaction, or it can be a off balance sheet item transaction, which are not part of the balance sheet. Okay. Now, for the purpose of this risk management, or for the purpose of some of the important things, how these transactions are accounted for at what place. So that we should know. So basically, bank have 2 books. They are, as per the transactions, bank have 3 types of, I can say that the 3 types of books are there. So one is called your banking book. Second one is called trading book. And third one is called off balance sheet book. So we should understand what is a banking book, which type of transactions are booked there, and what is a trading book, what type of transactions are accounted there, and what is off balance sheet book and what type of transactions are accounted there. Okay. So banking book is any transaction pertaining to deposits, borrowing, or loans and advances. So all the deposit transaction, all the borrowing transaction, all the loans and advances transactions are accounted in the banking book. The characteristic of this transaction is that this transaction, any transaction we make in the deposit, borrowing, loan or advances, they are normally made for a particular specific period. So they are made for a specific period. You see any kind of deposit, it is normally for a specific period only. Specific period. Till it remains with the bank, that is the specific period, unless that is repaid or that is withdrawn by the customer. So that means all these deposit, borrowing, loan and advances are called HTM category. HTM category is held till maturity. It's called held till maturity. That is the main characteristic of the transaction which are made under this banking book. So they are normally held till maturity. Normally. Not all the things. Some things may be not maturity before maturity. So this is the main characteristic. So banking book means those transactions which are held till maturity are to be under banking book. And another characteristics of these banking book transactions are there. Here the system of accounting which is followed, that is called accrual system of accounting. Accrual system of accounting means, accrual means when the interest is accrued, then only it will be applied. Before that, it is not applicable. Means in deposit or borrowing or loan, normally when we charge the interest, say deposit. So in case of deposit, if it is savings deposit, then every quarter we charge. So quarterly the interest is accruing. In case of fixed deposit, again it can be monthly or quarterly, at whatever, at simple rate or compound rate. So that is called a monthly, these are accruing. Similarly for loan, again they are charged at a monthly intervals. Loans and advances. For borrowing, for the period for which it is borrowed, on that basis that interest will be charged and interest will be given. So that means when the interest accrues, that point of time interest is charged to this type of account. So these are the main characteristics. And another thing we can discuss, that in such type of book, normally what kind of a risk which may happen. So basically when deposit, say in loan and advances and borrowing, there might be a credit risk. Credit risk means the borrower does not pay. So loan and advances, bank is the creditor, other party is the borrower. In borrowing, bank is the borrower, other party is the creditor. So credit risk might be there, or you can call that default risk might be there. Suppose we have borrowed money, we will not pay. So that is a default risk. But here, and operational risk might be there also, because deposit is there. So all other things, operational risk might be also possible. So here you see that credit risk, default risk, operational risk might be there, but there is no sign of market risk in the banking book. So market risk is not there. Okay. So we have covered deposit, loans and advances. So all these deposit, loans, everything covered. Now trading books, only this investment part is left. So trading book pertains to the market or to the investment portfolio. Entirely investment portfolio, what are the transaction happens, they will be recorded in the trading book. So that means they include all the assets, because it is the asset side. So all the assets which are traded in the market. Normally those assets which are kept for trading in the market by the bank, they are in the trading book. So basically we see that all the investment which the bank has made, they are the assets which are going to be traded. These are the characteristic is they are not always held till maturity. Some of them are HTM category. They are generally held for a very short duration, and positions are to be liquidated in the market for which it is kept. Whatever position you are holding, that has to be liquidated. So some of the trading book portfolios are HTM category. Other two categories are more common. That is called HFT category and AFS category. HFT is held for trading. AFS is available for sale. That means these are the marketable assets under HFT category, means they are held for trading. So bank is having those assets which are required for the trading. Trading means bank may be buying as well as selling those assets. So those assets bank may buy from the market, or bank is going to sell in the market. So both buying, selling of those assets when it is happening, those are to be put under HFT category. AFS means available for sale, means it is only for sale. No buying has to be done. Such type of asset bank are not interested in buying. Only whatever assets bank is having, bank want to sell them. Okay. Now the accounting process here is accounting system followed. Here we know that accounting system follows accrual system in the banking book, whereas here the accounting system which is followed is called mark to market system. Mark to market means every day at the end of the day, whatever transaction we get done in the investment portfolio, means whatever buying, selling, everything is done. At the end of the day, we will see what is the gain or what is the loss. Bank will account for this gain loss, and this gain or loss, whatever is that, this has to be written off with the P&L account. So at the end of the day, every day the P&L account will be credited with gain or debited with the loss. Every day it happens. It is not as per accrual. Accrual means monthly, quarterly, whatever. Here, every day it happens. Whatever the trading time. When the bank's business is open, when the market is open, and that day, whatever the trading has been done, at the end of the day, bank will see whether there is a gain or whether there is a loss. Total thing, netting together. So if the gain is there, then that will be credited to P&L account, and whatever the loss is there, that will be debited to P&L account. So this system is called mark to market system. And in trading book, the bank is whatever transaction is done by the bank, they are subject to the adverse movement of the market, because the movement of the market price of any asset which is happening, that will be resulting in either gain or loss. So this loss or gain has to be liquidated every day. This is called liquidated every day. So that is called mark to market process. Man, you have to account it in the P&L account. That has to be liquidated every day. So this process, when the bank is trading the asset, and for that trading, if there are adverse movement in the market prices of some asset, then there may be a gain or loss which needs to be liquidated. So that risk is called market risk. So basically market risk happens in the investment portfolio only. Now all these things, mark to market is applicable for these two, HFT and AF's category. Remember that only. Since HTM category is always held till maturity, so this transaction will be booked in the banking book only. So this will be booked as if it is a transaction of banking book. They are not booked. So that means here HTM category, the mark to market concept is not applicable. This here they will be booked in the banking book, and there will be accrual system of accounting. So that is the only difference. Sometimes question comes, so you may have to remember this. Okay. Next one is off balance sheet. Off balance sheet means they are basically contingent liability or non-funded in nature, such as your bank guarantee issued by the bank, LC issued by the bank, derivatives issued by the bank, or you can say interest rate swaps issued by the bank, or futures, forward contract. So all these things, when bank enter into such things, they are not part of balance sheet. That's why for the time being, when they are issued, they will be under off balance sheet. But later on, as per the default of the counterparty, or as per the not fully fulfilling the commitment of the counterparty, these off balance sheet items may become funded one. And so when they become funded, they will be coming into balance sheet. So these off-balance sheet exposures may become fund-based exposures when the commitment by the counterparty are not fulfilled. So, when they are converted to a funded one, and depending on the type of exposure, they may either go to banking book or they may go to trading book, depending on what is the type of exposure is there. Okay, so this type of contingency adversely affect the revenue generation of the bank when the commitment is not fulfilled by the counterparty. Okay, so these three type of transaction. So these are non-fund based. Bank guarantee, LC, derivatives, they are non-fund based. Non-fund based means what? Fund based means when you are giving a loan, CC, OD, term loan, demand loan, bill purchase, whatever you are doing, means you are giving money to the party. Fund is given to the borrower. You give a loan to the borrower. Fund is going out of the bank to the borrower. In case of non-fund, no fund is given. No fund is given to borrower. Right now, it is only in paper bank guarantee is issued, LC is issued, derivative is issued. It is a paper-based transaction only. No money is involved. So those are called non-fund based transaction. How the swap is a fund based? How the swap is fund based? You are asking, Mr. Santeka. How the
Sir mentioned that swaps fund. That's why I'm asking.
How? All these are when the bank enters into contract, they are non-funded. When the thing will be made, then it becomes a funded one. Okay. Interest rate swap means what? You are entering into agreement that this thing will happen. After when it happens, then you have to book that. That time it will be a fund-based one.
Okay.
So all the things when they are issued initially by the bank, they are non-funded only. Okay. They are non-funded. So bank guarantee issued to somebody, but that counterparty has failed to not fulfilling the commitment with the beneficiary. So beneficiary will submit the bank guarantee to the bank. Bank have to pay it. LC is issued. If all these things commitment fulfilled means they will be non-funded. When the commitment by the other party or counterparty is not fulfilled, then it becomes non-funded.
Okay. Thank you.
All the examples are non-funded only.
Yes. Okay. Thank you, sir.
And a bank guarantee example, I am giving all the example I have given. Say bank guarantee. Say bank guarantee. What is happening? Bank guarantee is issued by the bank. Bank is the issuer. It is issued on behalf of a applicant who is your customer. Applicant will come to the bank and will say that please issue a bank guarantee on behalf of the beneficiary. So beneficiary will be there. There is a contract between the applicant and beneficiary where the beneficiary says you have to give me a bank guarantee. At that time bank guarantee is issued by the bank. So there are three parties involved. So applicant has to fulfill the commitment to the beneficiary. If in between that commitment is not fulfilled, then beneficiary will come to the bank and submit the bank guarantee, and they will tell that, so suppose this bank guarantee is issued for an amount of say 1 lakh. 1 lakh is issued. So on paper only it has been issued. That paper is, original paper remains with the beneficiary. Now commitment by the applicant is not fulfilled with the beneficiary. So beneficiary comes to the bank, deposits the bank guarantee. Bank has to pay 1 lakh. So 1 lakh payment has to be made by the bank. So when the bank will pay that 1 lakh, bank has to create a loan. So the loan, when from loan bank pays, so this is becoming a fund based. So every time, whether LC, a bank guarantee or anything, when the commitment fails, bank have to create a loan or create an investment portfolio to make the payment or make the investment in that case. So whatever the person, normally you will find that everything will be under banking book only. These things you should remember. These are the subjects of JIB, and you are asking me this question in CIB. This is very strange. So we know where it is booked. Sometimes question comes, that's why I have explained this thing. Okay. Then we will come to the measurement part. Kindly listen carefully, because if you do not understand the basic things, like you have asked how this example of how the non-funded become funded, so it will be very difficult to understand this quantitative measure. Please be focused on that. So trading book, very rare. Sometimes it might be possible. So that's why I told that sometimes this future forward contract might be possible that they will be booked in the trading book. But normally 99% of the things, they become the part of banking book only. There is no exact example where I can say, but sometimes it is there where the forward contract or swaps or future may be part of the trading book only. Okay, so that is a possibility. It is not that it will happen. So that is a possibility. That's why I told, depending on the type of exposure, they may be either become the banking book exposure, or they may become trading book exposure. So quantitative measurement, how to do the measurement. So what measurement is done under risk management? So basically, what is measured? We measure the variation in the earning. So we are basically concerned about the profit. So what is the difference in that earning happening? So we have to measure that. How much, when risk is there, means how much profit is falling or how much loss is happening. That is the main thing. So variation in earning in a negative way. When the variation is falling, that is the matter when risk comes. This is about earning, means when we earn interest. Normally in the loans and advances, we earn interest. Or in case of deposit, we pay interest. So when you earn or pay interest, at that time the profit is either it will be going up or it will go down. Okay. Next is to measure the variations in the market value. So here what happens, investment portfolio will come into picture. So investment portfolio, we have our assets. So every asset has a value in the market which is traded. So in case of the movement in the market prices, the value of those assets might also go up or go down. So when the movement is downwards, that is when the adverse movement of the value, market value of those assets happen, then that has to be measured. And this thing is to measure the losses due to default. So default might happen in the loans and advances or in the investment portfolio also. So at that time also loss will happen. So how these things will be measured? All these measurement are done under risk management, step number 2. So you have to measure these things. Okay. So this measurement of those things are done by different methods. Be careful, because from this method we will start, I will start explaining how these are done numerically, mathematically it will come. So you should be very careful. Please, you should have your normal calculator with you from now onwards, so that it will be easier to calculate. So now, first thing, normally see, in case of loans and advances or deposits, there is no complication in calculating what is the profit, or we can say what is the gain or what is the loss. Simple thing. suppose you are earning 12% interest. Now due to change in the MCLR, so rate interest was linked to MCLR. So you are charging 12%. Now MCLR is changed. Now interest has come down to 11%. So easily you can calculate what is the loss happening here. So we can say 1%. For this particular advance, 1%. So there is no complication in calculating the gain or loss when they are in the normally in the banking book. So banking book transactions, the calculation of gain or loss is straightforward, simple. So there is no need to calculate them. You can easily calculate how much you are gaining or how much loss you are losing. If you know the loan amount, you know the rate of interest, then similarly deposit also, how much interest you are paying. You know the deposit amount, how much you are paying, and in future it is going up or going down. So that way we know that how much we are losing when the interest goes up and how much we are earning when the interest goes down. So that is simple way. So that is not to. But in the investment portfolio or the trading book, since this is according to the mark-to-market concept, means every day we have to calculate this thing. So they have to calculate it with a different type of tools. Different type of tools are used by banks to measure those type of losses or those type of movement, adverse losses or gain which may have happened due to the adverse movement of the market value or market price of the assets. So first method is sensitivity method. Just I am showing this, then I will explain each one by one. First method is sensitivity method, where these two are the tools which is used. One is called MAC duration, second is called modified duration. Just remember this. Second method is volatility method. Volatility method, we have two tools. One is called basis point value, BPV, and another is called value at risk. So all these are used, these are the tools or instruments used to calculate the risk. How much loss? Normally calculating the loss only. Profit is not required, but sometimes profit is also calculated. So these are the things we have to calculate. Okay, so I will now explain what is sensitivity. Then I will explain how this MAC duration or modified durations are used, how these are calculated. Then we'll go to volatility. Then we'll go to, in under volatility, I will explain BPV, VAR. Because definitely at least 3 to 4 questions are expected under this entire risk measurement. And always 3 to 4 questions are asked. So you can have up to 5 marks questions will be there for sensitivity and volatility. Okay. Now we'll see what is sensitivity. Sensitivity, this is a English word where we know what it means. It means how much sensitive you are. Some people are there, they lose their temper very quickly. In once, so 10 seconds, they will lose temper and they will be very angry. That means they are very sensitive to those kind of situation. But similarly, some of the people are that they are not so sensitive. So they will be pretty cool during that process. Okay. So Amitabh, you are only complaining that my voice is not coming. What about other people? Other 100 people are also there. Can you hear me?
No problem, sir.
Yes, sir.
So Amitabh, please check your check your instrument or laptop or mobile. So please check, because everybody can hear me. So please see your, okay. So sensitive means how much sensitive you are to a particular situation. Some would be easily anger, someone would be very cool. So that means what? According to particular situation, how the movement of your anger is happening. Okay, that I will explain to that. That means what? Sensitivity means it is the measure of deviation of a target variable due to change in the single market parameter. So here target variable is what? Here our target variable is say profit, gain or loss. Our variable is gain or loss, which varies. So either there will be gain or there will be loss, and what will be the gain or loss. So that is the variable we want to measure. So deviation of target variable, how much? Normally risk means we are measuring the loss normally. Gain, when there is a gain, there is no risk at all. So we will measure the loss. So how much the loss is changing? So what is the deviation of this loss? How much the loss is moving due to change in single market parameter? So I told you in the beginning that these are the measurement of our investment portfolio. So all the assets which are traded in the market, they can change the value of those things. Asset may change due to movement of market price or other things. So the market price is one of the parameters. So there are different parameters in the market. If they change, then definitely our profit or loss will change. So sensitivity measures that deviation in the loss or gain due to movement of single market parameter, not all the market parameters. So what are these market parameters? These market parameter might be interest rate, exchange rate, stock prices, market liquidity, demand supply position, or inflation of the country. So these are the different market parameters. Any change in any one of them will affect our gain or loss, our target variable. So sensitivity measures only the loss or gain due to change in one of these parameters, not all the parameters. If there is a change in multiple parameters, then you have to calculate the change as per interest rate separately, exchange rate separately. So altogether in a composite way, this cannot be measured. That is one of the drawback of sensitivity method. Is it clear to you? All of you understood this concept? If you yes, then I will start the MAC duration, modified duration. Do you understand?
Yes,
Yes, sir.
So that means due to change of interest only, what is the loss? How much we have suffered loss? Or there might be a foreign exchange thing due to change in the exchange rate. What is the loss we have suffered? How much the loss or profit has moved? Or due to the price of the asset which is traded in the market, how much is the loss or gain? So these are the things which affect the asset value. So for each one separately, this sensitivity method will be applicable, that will be measuring. So if a asset is there where there are three things changing. So compositely three things cannot be made together to find the loss or gain. We have to calculate separately, for interest rate separately, for exchange rate separately, for stock prices separately. That is the drawback of sensitivity. Okay. Now suppose example, just I am giving it up. Suppose you have a say due to there is a interest rate change market, or we can say the rate of interest in the market of that asset has changed. Say that interest rate changed by 1%. So 1% change in interest rates. Whenever this triangle I am using delta means change in the rate of interest of 1%. So the market value will change. So what is the amount of change happened? Suppose due to 1% change, whether change means what? Change might be 1%, the market rate is going up or it is going down. Change means that whether market is going up or going down. So that is called a change. I'm directly not telling that market is moving upwards, rate is gone on upward or rate is gone downward. I'm not told. I'm only told that rate change. Rate changing it might 1% is going up or going down. So due to 1% change in the interest rate, what is the price or market value? Market value is changing. Maybe earlier it was 95 rupees and it has become 92.50 rupees. Or earlier it was 95 rupees, it has become 97 rupees. So it is possible. So if it becomes 92.50 means we have a loss of 250. If it is going to 97 means we have a profit of 2. So gain or loss will be according to that. So that means for a change of 1%, this is 2.50, and for one change when it is going appreciating, it is 2%. So we can say that for a 10,000 rupees portfolio we are having. Suppose one of the asset we are having, say 10,000 rupees. Suppose 10,000 rupees portfolio we are having, and suppose the market value portfolio is 10,000, and for 1% change in portfolio, what will be the, suppose this is the 1% change. So how much it will be impacted? 1% means it will be rupees 1 lakh, right? No, it will be 10,000. Sorry, 1% is 10,000. So impact will be 10,000. So we can say that for a portfolio of 10 lakh, the sensitivity is 10,000. Means it measures what is the change due to 1%. Okay. So interest rate sensitivity of this portfolio of 10 lakh is 10,000. That means sensitivity measure on a unit of 1% only. Clear? So the interest rate gap is the sensitivity. So what is the gap? In case of banking book only, I told what is the gap. Earlier, we are earning 12% rate of interest on the loan. Now 11% is the rate which has changed. So interest rate gap is 1%. So we know how much we have a gap. So this gap is 1%. So here it is minus 1%. So if you know the amount of loan, easily it can be calculated. So banking book transaction sensitivity collection is very direct. There is no problem. So only the interest rate gap is the sensitivity of the interest rate margin of the banking book. So this is the gap between 12 and 11 is 1%. So this is the sensitivity. That's all. But in case of trading book, duration is the sensitivity of investment portfolio of trading book. So you should remember sometimes MCQs are coming for this thing. What is the sensitivity of banking book? So you can say interest rate gap is the sensitivity of the banking book. And what is the sensitivity of, how the sensitivity of the trading book is measured? It is measured through duration method. Okay. So these are the simple things we should understand. And as I told you, sensitivity method has drawback. So one drawback is that, as I told you, only one parameter, single parameter can be measured through this sensitivity method. All the things together, it cannot be. So it measures the one market parameter change. One market parameter when it changes. So it is based on one market parameter only. So when the impact of other market parameter is there simultaneously, so it cannot be measured simultaneously. It has to measure differently, separately. Second thing is that sensitivity always depends on the prevailing market condition, totally based on market condition. So when the market condition is normal, so market is behaving normally, then the measurement of sensitivity are accurate. When the market behaves abnormally on any day, so there is abnormal changes happening rampant changes happening due to some of the economical region or something. So market environment changes frequently. In such cases, the accuracy of sensitivity method may not be that much of correct. So accuracy will be less. Okay.
In which case, sir, abnormal case?
Abnormal. So always see this sensitivity method will give you accurate result on the normal market condition. Okay. So when that is a condition is abnormal someday, that day you may not arrive at the correct answer. It will be changing next moment only. So your answer might be changing again. So at that point of time, it will change. So that is also variable. Now we'll see how this MAC duration, modified duration is used, how this is calculated and where it has to be used. Okay. Basically, whenever we are talking about investment means either shares, bonds or debentures which are traded in the market and bank has invested that or somebody has invested that, at that point of time, the price, what would be the price or what would be change in the price or what would be my loss or gain due to change in the interest rate. So that has to be measured. So how these are measured? By using MAC duration and modified duration. So MAC duration says that it is the sensitivity of a bond's price or shares price to the change in its yield rate change. So whenever this, basically it is about bonds. Bonds, normally whenever bonds are there. So in case of bond, I think in the bond has been told to you in the treasury classes. Treasury classes has happened. You know what is a bond? How the bond market operates? Anybody? What is a bond?
No, sir.
You
Issued by
do not know.
government.
Okay.
Instrument
So
to raise debt.
basically, they are the debt instruments. They are the debt instrument. Debt instrument means somebody wants a loan from the general public, not from the bank. So they will be issuing some kind of debt instrument where the public will invest. So that instrument is bond. So generally, these type of instruments are issued by government, or selected corporates are also allowed to issue. So government means state government or central government may issue. So whenever the government wants money, they want to borrow money, they will not go to RBI to borrow money. They will come to the public. They know that public has surplus money, so they will be issuing the bond, and public will give the money. So it is like a fixed deposit scheme floated by government. So bank fixed deposit. So public comes and gives money. So we are borrowing from the public. Similarly, government will issue that bond. Only difference from fixed deposit is that these bonds are traded in the market. Traded means you can buy and sell these bonds in the secondary market, share market. It is possible because they are listed and it can be traded. That is the only difference. So basically, when these bonds are issued, the feature of bond is that the bonds have a face value. Say face value might be 100 rupees or 1000 rupees or face value. So if you want to purchase 1 lakh means you are buying 1 lakh divided by 100. That much of bonds you are buying, number of bonds you are buying. So there will be a face value and there will be a rate of interest paid by the government. That rate is called coupon rate. So bond interest rate is always called coupon rate. Whenever you hear this coupon, it means it is relating to the bond only. So coupon rate, suppose coupon rate is 5% per annum. That means on 100 rupees, government is paying you 5 rupees per annum. So this coupon rate may be payable annually, half-yearly, quarterly, or monthly also, as per the agreement. So you will be receiving 5 rupees per year on 100 rupees. And when they are traded, in the market when are traded, there will be another rate which is called market rate, or that is also called yield rate. So this rate will be different from your coupon rate. So this rate may be 4.5% or maybe 6%, which may be or equal to 5% also, both all possible. So it may market rate and yield rate will change according to the demand and supply of the bond. How people are reacting to that, how people are buying or selling it. So according to that demand and supply, this market rate or yield rate changes. And due to this change, the price or the coupon, which is normally the price of this bond which is traded in the market, this will also fluctuate. The changes of price happens. Okay, so this is the thing. But coupon rate does not change. Coupon is always constant. This coupon is to be paid to the government, paid by the government to the bond holder. Whoever holds the bond, he will get the coupon rate annually this much. Okay, so in such case, always remember one basic fundamental thing you remember, that is whenever, so that is a coupon rate and the market. So market rate, today market rate is say 4.5% and the coupon rate is say 5%. Coupon rate is 5%. Today market rate is 4.5%. Tomorrow this market rate is maybe 5.5%. Our market rate might be 4%. So it will change accordingly. So here when the market rate is improving, means it is plus, market rate is going up. And here it is market rate is gone down. So always remember, whenever market rate is going up, the price of bond will come down. This is the basic relation. And when the market rate falls, the price of bond will increase. So there is a inverse relationship between price and your yield rate. So yield rate and price has got an inverse relation. Whenever yield rate increases, price will decrease. Whenever yield rate will fall, price will increase. This is the basic rule you have to understand. So question is asked that the rate has gone down. Simply your answer will be always the price is going up. Sorry, rate has gone down and price is going up. Okay. So if the rate has fall down, price has gone up. If the rate has gone down, price will go up. So this is the basic rule you have to follow. Okay. Is it clear? Then I will discuss. Any doubt on this? Rate of movement of the price will rate of movement of the rate of interest will change the price. So rate of interest, or we can say this is the yield rate or market rate. So remember, when market rate goes up, what happens to the price of the bond?
Fall.
What happens? Price will be falling, going down. Always 100%. This is the answer. When the yield rate is falling down, price will go up. So this is the relation you have to remember. Okay. Now, suppose there is example 5. We will see how this MAC duration is calculated and how this modified duration is calculated and where it is to be used. Suppose there is a 5-year bond. Face value is 1,000 rupees. Annual coupon rate is 4%. And the current market interest rate is 4.5%. Simple thing. So we have a value of 1,000 rupees. Coupon is 4%. That means how much coupon you are getting. Suppose you have investment rate. How much coupon you are getting. So this is a 5-year bond. So we can make a column here. So I am making the column as time period. So time period is 1, 2, 3, 4 and 5. These are the 5 years. Okay. Now we'll say that our next column I'll write what is the coupon I am getting, coupon amount I am getting. So first year, how much I will get? What is the amount I am getting on this coupon?
40.
40.
40.
40.
Second year,
40.
40. Third year, 40.
40.
Fourth year, also 40. Fifth year, I will get back 40
1040.
plus
That's awesome.
face value. So I will get 1040.
40.
So at the end of 5 years, I am getting how much? 1200. Clear? So that is the thing. Now, these coupons I will get. Suppose today I have invested. This 40 rupees is available to me after 1 year. This is available to me after 2 years. This is available to me after 3 years. Like this, these are available. So that means if I have purchased today this bond, so I want to see what is the actual value today. If the 5-year value is 1200, what is the actual value today? So that means I have to calculate what is the present value. So each coupon rate present value I will calculate. Then I will calculate the total where I will get the total present value of this one today. So that total present value what I will get, that will be the price at which I can sell or buy that bond today in the market. Clear? Because 40 rupees is after 1 year. So today this value will be more or less. Just simple logic. Today the value of 40 rupees today is more or less.
Yes.
Less.
Always less, because we know that today if you invest the 100 rupees where 6% interest will be available, after 1 year it becomes 106. So 106 is the future value. So present value is always less. So definitely this is a future value. We have to come to the present value. So present value will be always less than 40. Clear? Simple thing. So how to arrive at present value? That is a formula to arrive at present value. So what is that formula? That formula is simple: cash flow divided by 1 plus your market rate or yield rate to the power time. So can you find out? So here yield rate is how much? 4.5%. Coupon rate is not required at all. Coupon rate is for calculating the coupon amount. Next, we will always deal with the market rate. So yield rate is the market rate. So can you calculate the present value of this 40 rupees for first, second, third and fourth year and also fifth year also? You please use your calculator and tell me. So you take this 4.5% as 0.045 divided by 100. So it becomes 0.45. So you calculate and tell me first, what is the present value of this 40? Just calculate this formula, na? Are you doing it or not?
38.27, sir.
38.27 another. So is it 28 I can write? 276 or something is there?
Yes,
Okay.
yes.
277.
Second thing, simply suppose if you are using simple calculator, when you enter this first formula, you have done that cash flow divided by 1.045. You have done. So you have calculated here 40 divided by 1.045. Okay, simply you got this 38.28. Now you don't have to do anything, just press equal to. So you will get the second answer.
36.6291.
36.629163. Again press equal to.
35.05.
05.
Again press equal to.
33.54.
33.5424.
3.54.
54. Okay, up to this, simply you have to do one. Simply after equal to, you do not have to do anything. Because equal to means t becomes 2. Then again equal to means t becomes 3. Again equal to means t becomes 4. But here you have to do it again, because as long as cash flow is same, you can follow that method. But here cash flow is totally different. So either you can do equal to get the 40 answer, plus you have to do the 1000 rupees separately, or you can do 1040 divided by 1.045 to the power 5. So tell me what is the answer. 800.
834.60.
34 point
6039.
60. So these are the present value of this future value I have got. Now you total this and tell me how much it is coming. 900 something it will come.
$978.1.
978.10. Okay, that means this is the present value. So nobody is going to buy this bond more than this price. If you want to sell it, suppose you are holding this bond, if you want to sell it, nobody is going to pay a 1 paisa more than this 978.10. So this is the price which will be decided in the market. Okay, so next step we have to follow. So this is the present value. Now to get the MAC duration, how to arrive at MAC duration? For that, another step has to be followed. So that step is next column. Yes, any question?
Sir, that how you got a present value constantly? I'm not getting this.
Which calculator you are using? If
It's
you
a
are
normal
using
one,
your
sir.
mobile, it will not happen. So don't use mobile.
No, not mobile. Calculator only.
Calculator with Citizen, normal calculator.
Casio City, yes. Casio.
Okay. So you do 40 divided by 1.045. What is the answer you are getting?
1.045. 3827.
Now press equal to only. Again, press only equal to.
Okay.
Press.
Yes, sir. Yes, I'm getting.
Getting, na?
So fourth time I have to do.
Yes. So first time this will come, second time this will come, third time this will come. Okay. So these are the shortcut tricks you have to know. Okay.
Got
Now next column, fourth column we have to do, which is the PV of time weighted cash flow. Time weighted cash flow.
So the
Means
fifth one, 1040 divided by 1.045.
to the power 5. Here to the power 5. Here you see the formula. So first you calculate 1.045 to the power 5. What is the answer you are getting? Then divide it 1040 to be divided by that amount. So it will become 834.60. So next column is PV of time weighted cash flow. That means simply it is PV multiplied by T. So this column multiplied by time column. So first one is 3828 only, because 3828 multiplied by 1. Next one is 3663 multiplied by 2. Next one is 3505 multiplied by 3. Like this you can multiply all these things together and you can tell me the answer for this column. PV of time weighted cash flow. That is nothing but present value multiplied by time. How much you are getting?
73.2. The second is 73.26.
Okay.
70.10.
70.10.
Yes, sir.
How 10? It will be 15, na? 100. 105.15. And this will be
134.1.
134.1.
next one will be
4173.
4172.7.
417. No. Oh,
4173, sir.
Or 1.
4173.30. Okay. Now total, you make the total of all this. 4,500 something.
23.52.
4,500
23.52.
point. Okay. So we have got PV and we have got PV to time weight. So suppose this is A and this is B. Simply, this is A and B. So now MAC duration equal to, I'll write here, what is the MAC duration and what is the need of MAC duration? What does it tell? I'll say. So MAC duration equal to simply B divided by A. So how much you are getting? B divided A.
4.63.
4.63. And this MAC duration 4.63 is a time. So this is year. Because here we have PV into T divided by PV we have done. B and A. So PV cancel, so only time remains. So 4.63 is the time period. So MAC duration is the time period. Answer is time period. And it means what? It means that if a bond holder is holding this bond, if the person is holding this bond, he must wait for a period of 4.63 years to receive the present value of cash flow at the current interest rate. That means this bond I am holding, I am selling it, so I am getting this price. I am getting this, selling it this. That means the person who is buying it, he is paying me 978.10. But when he will get this 978, today he is paying. Today's value is not that. So when the government will pay that amount, that means the person has to hold it for 4.63 years, where he will get this value of this one. Clear? So MAC duration is the duration or time period for which a bondholder must hold the bond to receive the present value of cash flow at the current rate. If the rate of market rate is stable at 4.45. If it changes, then present value will change again. Okay, so MAC duration you got. So first we have to arrive at the MAC duration. MAC duration we have got 4.63 years. This is always in years. Okay. Now by using this MAC duration, we have to arrive at what is the modified duration. This is required because this will decide to measure the sensitivity of the bond. So how this modified duration is to be calculated? Modified duration is equal to MAC duration divided by 1 plus divided by K. So here MACD you have got it. So it is 4.63. Here yield rate is 4.5, that we know. So yield rate is 1 plus 0.045 divided by K. Now what is this K? K is the frequency of coupon payment. So here what is the frequency of coupon payment written here?
Annual.
Annual. So whenever coupon is paid annually, K is always 1. When coupon is paid half yearly, K will be 2. When coupon is paid quarterly, K becomes 4. Okay, like if it is paid weekly, K will become 52. A monthly 30. So these are not to be asked. So only remember K is 1 when the coupon is paid annually. K is 2 when it is paid half yearly. Okay. So here, since the coupon is paid annually, so K will be 1. So what is the max duration for this? 4.63 divided by 1.045. So how much it is?
4.43.
4.43. So this is not year. This is simply a number. Okay. Now, how this modified duration is to be used? Now, by using this modified duration, we can calculate if further the market rate or yield rate changes, then what will be the change in the price of this bond? This can be calculated. So you remember this formula, price change, percentage price change. So I am writing here price. Percentage price change formula is percentage price change of the bond equal to, the formula starts with a minus sign. Always it is a minus sign because I have told you that is a inverse relationship between yield rate and price of bond. That's why formula starts with a minus modified duration into your yield change. What is the yield change? You have to see. So suppose I will say that here the market risk, it is 4.5. Now market rate has changed to say 5%. So what will be the price change? So it will be minus sign with 4.43 into what is the yield change here? Yield change is how much?
Plus 5.
Plus 5. So it is a plus 0.05. 0.5, sorry. 0.5. So what is the rate is coming now? You multiply this. How much it is coming? 2.215. Yes or no?
Yes, sir.
2.215. So we can say, convert it to percentage. So we can say if the market is going up by 0.5%, the price will come down by 2.215%. Similarly, suppose the question will say that market has gone down by 1%. Rate has gone down by 1%. So what will be the answer? Minus 4.43 into minus 1%. So it becomes minus and minus become plus. Here it is minus and plus is minus. So that's why the price will go down. Here minus and minus means price is going up by 4.43%.
Sir, 0.5 from where you got, sir? First one.
4.5 to 5% I told. Now where are you? We are not listening to when I am telling. Market rate was 4.5. It has come to 5%. So difference is 0.5. It has increased by 0.5. So that's why it is plus 0.5. Okay.
No.
Is it clear?
Yes,
So
sir.
this type of questions will be asked. If together both things are asked, you have to calculate max duration and modified duration and find the price change. That question will definitely carry 2 marks. If 1 mark question is there, either they will be telling that find the max duration or find the modified duration only. Clear? You can do for any of the bond this max duration and modified duration. There is no problem.
So the last step.
2.215 is the what, sir?
2.215 is the change. Here I told now what I have written here. This is the formula. Change in price in percentage. This is the change in price in the percentage. Is it clear or not?
The last step, sir.
What last step? Which last step?
That minus 4.43.
Huh. So I told that if, see, here we have got modified duration as 4.43. That is constant for this. Is it okay?
Yes,
Okay.
sir.
Now, instead of this change, I had told that earlier market rate was 4.5. Now market rate has gone down by 1%. So same formula will be applicable. Gone down by 1% means what is the yield change? Yield change is minus 1% or not?
Yes, sir. -1.
So simply, so question will be asked either this is the rate of interest now, or market rate has fall by this, or market rate has gone by this, gone up by this. So that is the change only. So you know modified duration, you multiply it with the yield change, you get the percentage change. Okay? So do not forget to put the minus or plus sign. Minus is always there first in the formula. But second thing, yield change, also you have to see whether it is a plus or minus. According to that, the result will be plus or minus. So always you see when the interest is going up, price is falling by. When interest is going down, price is going up. Okay, clear?
Yes, sir.
There is no problem for MAC duration and modified duration. Sure? I am erasing it.
Modified duration, max duration 4.63 years. Then 4.4 modified duration, sir, 4.43 years.
No. This is not year. Only MAC duration is in time. This is the only figure. This is numerical figure. This is not in years. This is required to be multiplied with the change of yield to get the percentage. So this is not in years. This is a number. Okay. This is a number because this is simply a number because we have divided the year with some interest rate. So it cannot be year. It should be a number. Modified duration is a number. MAC duration is a time period. So this number is required to calculate what is the price change percentage by this formula. So this is the only formula you can apply, and apply this formula you can get it how much the price is changing. So question will be asked directly like this, or reverse question may be asked also. Okay, clear? Sometimes they will ask that if the price, so what is the, so current price is say 978 something. So if the market rate changes to 5%, what is the new price? So according to that, market rate will fall down by 2.215. So you have to reduce 978.10 by 2.215. Then you see what is the amount. Price, how much it is coming down. Because if the current price is this much at 4.5 rate, 5% yield rate, if the yield rate is increasing by to 5%, means 0.5% rise. So in that case, 2.215 fall. So 978.10, how much fall? 2.215. So what is the price? Can somebody calculate and tell me what is the price fall? What is the 2.215% of this 978.10?
Modified duration.
I just calculate 2.215% of 978.10.
41.5.
Pardon?
441.5.
441.5.
21.66.
66. So 21.66 has to be reduced. So what will be the price here? So price will be 956.44. This will be the price. So such type of question will be asked. Okay? Clear? You can do it?
Sir, once more. Sir.
What once more? This is not a song that I'm singing once more. अरे पहले 100 रुपीज था, डेप्रिशिएट किया 5%, तो कितना होगा? 95 होगा ना, इट विल बी 95 ना. 100 rupees was the price, 5 rupees depreciation price, rate has come down, so it will be 95 na. So 5% of 100 you less from this. So similar here, 978.10 was the earlier price, and there was a decrease of 2.215%. So how much it will be the price now? Same thing you have to follow. How much will be the price? So 2.215% of 970 is 21.66. So if you reduce this, it becomes 956.40. So 956.44 will be the current market price at the yield rate of 5%. Clear?
Yes, sir.
So if it is to be added, you add this one. If it is to be subtracted, subtracted this one. Simple. 100 was there, 5% is the change. What will be? Whether it will be 95 or whether it will be 105. If it is decreasing by 5, it is 95. It is increasing means 105. Clear? Should
Yes,
I
sir.
move to the next? So your MAC duration sensitivity method we have done. Okay, now we'll go to volatility. So first we'll see what is this volatility. Sensitivity we have measured. Sensitivity is how much the change is happening in the price when the rate of interest changes or exchange rate change. So we have calculated rate in the rate of interest. So accordingly, any of the other parameters can be calculated. Now volatility means what? Volatility means how much is it is changing frequently. So volatility is about the stability or instability. How much it is stable or unstable due to change in the market parameter. So I can say that volatility is about the stability or instability of any random variable. So whatever random variable we are to measure, how these random variables are stable or unstable. That means this is the, suppose this graph says that price is remaining constant, means this is stable. Price when remains constant for a period of time, it is stable, same prices. Now unstable means the price is going up and down like anything. So this moves up down. So this is instability. It is not in a simple parallel line. It is moving up and down. So it might be stable or it might be unstable. So what are those random variables? So again, same thing. We are looking at our profits or earning, how much the profits are changing, or mark to market value means again it's a profit and gain. We have to compensate that profit and loss to the account, or the market value of the asset that is falling up and down, or the fall of value due to loss by the counterparty who has defaulted. So these all things can be calculated through the method called volatility. So here only change we are not calculating. We are seeing the frequency of stability and instability. Okay. So volatility is measured or calculated through a procedure called standard deviation. Sensitivity you have calculated through MAC duration and modified duration. But volatility is captured as standard deviation of these values. So whether one of the value will take the data and find its standard deviation. And what is that standard deviation? I will let you know in the next slide. Okay, so that here the standard deviation is the square root of the variance of the random variable. This is the definition. Do not worry about the definition. Next slide, I am going to tell you how this is to be calculated. Suppose I am taking a value of a share, particular share. I have taken the value, monthly share value I have taken. So March, April, May, June, July. So this is the share price, market value. Share price I have taken. March it was 100 rupees, say April 110, May 90, June, July price. 5 months data I have taken. Now I have to find out what is the standard deviation for these 5 months. So to find out that standard deviation, first I have to find out what is the mean price of these 5 months. Mean is the average. So I have total all these 5 and divided it by 5. So first average, when you calculating mean, that means whatever the samples you have collected. So I have collected 5 samples. So to sum of the sample divided by the n, that becomes our m. So whether it is 114 or not, so I have calculated this is 570. So 570 divided by 5 is the mean. So 114 is the mean price. Or I can say that 5 months this prices are fluctuating. So average price is 114. Clear or not? This mean is okay. Now I cannot go to previous slide. Okay. So just remain in this slide. When I'm just beginning this thing, you should come. Let me first complete this slide. Then I'll show the earlier slide. So mean is, you understood the mean price? 5 share prices given, and what is the mean price? Yes or no?
Yes, sir.
Okay.
Yes, sir.
Now from mean, next column is we have to find the deviation. Deviation is nothing but the P minus M. From the share price to mean price, what is the difference? That is called deviation. So P minus M. P is the share price, mean price is 114. So here it is minus 14. Next is minus 4. Next is minus 24. Next is 6. Next is 36. So difference between share price and mean price. Now next column is you have to square this deviation. Whatever deviation you got it, you have to square it. So that becomes 196, 16, 576, 36 and 1296. So everything will be a plus. So I have given total of this square of the deviation. So that is 2120. Now next step is we have to take the average of this sum. 2120 average, but this average is different than taking the mean. Here always remember, for a small sample data like this, always you should take the average by taking the denominator as n minus 1. It is not n. Normally average is 2120 divided by n or 2120 divided by 5. But here you have to divide it by n minus 1. So 2120 divided by 4. So it becomes 530. So this is the square root of the average of square of deviation. Now standard deviation will be square root of 530. So square root of 530 is called the sigma or standard deviation, which is represented 23. So I can say standard deviation for this is 23. Okay. So always remember that for small data sample, you have to divide by n by 1 to get the correct answer. That is a simple thing. Why it is 1 minus 1? I don't want to break your head or example.
Yes, sir. Up to what sample n minus 1? Up to one sample, like it is 5.
So, suppose in a examination they will give a sample of 960 sample. Can you do that in 1 minute?
No.
So normally they will be asking to 5 to 10 samples only. Is it possible to calculate without a Excel sheet? 960
No, sir, my question is up to what sample you have to take 1 minus 1?
No, I don't want to explain that. I told you that in your examination, if you are asked to calculate this one standard deviation, you use this n minus 1. To get that answer, you please search in Google, explanation will be there. You have YouTube, explanation will be there. Okay. For small, I told you for small sample, use n minus 1 to get the accurate answer. Simple thing. That's all. For further answer, Google is there. You can ask. It will be easily explained there. You can get it. So now Have you got the standard deviation? How we have found out the standard deviation?
Yes, sir. Yes, sir.
Okay.
Sir,
So
can you repeat
it
the mean please, sir?
mean,
Mean. Yes.
अरे यार कहाँ थे आप? Mean means total 5 prices are there. Average is the mean. Mean means average. How to calculate the average of these 5 prices? How we are taking average?
Summation P by
Addition and divide.
Add all the 5 values and divide by 5.
So that is the average. That is the mean. अरे यार पूरा स्टोरी खत्म होने के बाद आप पूछते हो कि राम कौन सा कंट्री में गए थे रावण को मारने के लिए? When I am explaining from starting, everybody understood. Now you are asking the what is mean. Mean means average, simple thing. If you cannot understand mean, how can you come out to calculate standard deviation? You should be careful when I am explaining this numericals. There will be total 4 hours class of numerical. At that time, you have to be focused. Otherwise, it is your risk. I'm telling you. So this way 23 is the standard deviation. Now why we have calculated this? What does this 23 mean? This indicates, this is approximate, this is not accurate. This indicates that share price of 5 months have fluctuated either way, plus and minus fluctuated from the mean price. Mean price was 114. So by this way it has fluctuated by 23, and this way it has fluctuated by 23 according to these 5 data. This might not be exactly correct, but to get that thing, I have told that this is the minus, this is the plus. So 114 plus 23 has become sometimes, and 140 minus 23 has become during this 5 months. So the lowest price was this much and the highest price was this much. So standard deviation tells us that from mean, what is the equidistance both way the price might have moved. So this is basically we have calculated this as per month only. So we can say this is the monthly volatility of this share price. So monthly volatility is 23. Suppose we can say that within 1 year period, the price may go up by 23 or may go down by 23. That is the calculation. Clear? So here, monthly volatility. So I have calculated the monthly volatility as 23. So this is our monthly volatility. Sometimes questions will be asked how to convert a daily volatility into weekly volatility or monthly volatility or any number of volatility or any monthly volatility, how to convert into daily volatility. So this is monthly volatility. How to convert it to daily volatility? Or sometimes to be calculated that 7 days volatility you calculate, 45 days volatility you calculate. So how these are to be calculated? So if such volatility calculation we have to use the square root of the time rate. Suppose a volatility of a portfolio to be calculated for a time period T. So the volatility is given for a time period T, where it is time period is T and where the daily volatility is given as D. Say daily volatility is given as D. So we know that the daily volatility amount is D, and question is asked to calculate the volatility for a period T. In such case, the volatility will be D multiplied by root of T. So volatility will be T multiplied by square root of T. Suppose I say if the daily volatility is say 1.5, then find out the volatility of 45 days. So volatility 45 days. That means daily volatility is 1.5 into square root of 45. So how much it is?
10.062.
What? 10.062. So this is the daily. This is the volatility for 40 days. So other way, reverse way, the question might be asked. Clear? Is it clear?
Yes, sir. Yes.
Volatility is clear. If it is clear, then we can, I think today's time is over. Next, we will talk about two more things. What is BPV, basis point value, how it is calculated, and what is value at risk. These are more important again. Questions will be coming definitely. So at least 6 or 8 marks question will be coming on sensitivity and VAR volatility. Any question till now you ask me, otherwise you will say good day today. Tomorrow again we'll meet. Tomorrow is a Saturday. There is marathon class tomorrow. We have class in the morning 9:30 to 11, from 11:30 to 1 p.m. and 4 to 5:30 p.m. So 4 and 5 hours class tomorrow. So maybe tomorrow we'll complete the risk management and next day we'll start the balance sheet management. Any question till now you ask me?
Sir, monthly volatility to daily means?
The formula is simple. Formula I told you that daily volatility multiplied by square root of T. This is the volatility. Formula is V equal to daily volatility into square root of T. So what type of volatility, which information you are having? Out of these three, some two information are given in the question. So you tell me what information you are having.
We have monthly volatility.
Okay, monthly volatility you are having. So you are having this monthly volatility. You have to find out this daily volatility. You have to find out, right?
Yeah.
So
okay,
how to find out?
Monthly volatility into 30 only, no? D square root of 30.
So normally monthly means they will see. Normally what happens now in this trading questions, whatever this market risk questions are, market risk questions, whatever is there. So normally in market risk, always remember Saturdays, Sundays are not, markets are not open. So week means 5 days. And a year means 250 days. Always that is whenever these VAR questions will come. Na? So at that point of time, 1 year means 250 days is taken into consideration. It is not 365 days. All over the world, these things. So question will be giving you how many days. So if they say 1 year, then it will be written, assume that 1 year is 250 working days. So monthly will not be given normally. They will say monthly in a month, there are 25 days or 26 days like this. So you have to calculate that one.
Okay.
Clear?
Okay, sir.
Okay.
Thank you.
So they will not give monthly. Monthly means you will be confused. How much, whether I will take 30 or I will take 25 or 26. There might be 4 Sundays. That so 26 also you cannot take in a month because Saturday, Sunday total 8. So there might be 22 or 23 days also. So they will be giving you, if it is monthly or weekly, they will give that weekly means 5 days in a week. Monthly means 22 or 24 days in a week. That has to be given.
Okay, sir. Thank you, sir.
Hello. Sir.
Huh?
Weekly means 52 only, no?
Pardon? See, this weekly, they will be not giving you.
Okay.
They will, because calculation on that thing will be very difficult. The weekly thing they will not give. Normally, they will give to calculate this much of days, 45 days, 30 days. Weekly, they will not give. You can calculate that thing, but it is not. So weekly means, again, weekly means 5 days you have to take, not 7 days, because that will be given. Week has 5 days, 5 working days. So that is the T. Square root of T is the, what is the days you are taking. Formula you should remember. So D into square root of T. So anyway, you can just exchange those things. What is asked in the question, in the what way the question is asked, is we apply that formula. Whether it will be D multiplied by T, or what is the answer given divided by D, or what is the answer given divided by square root of T. So that way it is simple thing. Anything else?
Sir, can you give few
Sir,
numericals for exercise or practice?
See, these numericals are available in the mock test of IBS Vigyan. Huh? So many numericals. Risk management has got so many numericals. You will find I have also posted around say 200 or 300 numericals there. You will find that all those set and say set risk management set will find with a extension of RKM. Whatever the RKM extensions are there, they are posted by my. They are my questions. Other than that, that are the questions of different other faculty mixed together. It is done, but the sets you will find extension of this. It is suffixed by RKM. Those are my questions. So you can attempt those questions. All the questions are there. So many questions are there. You start doing this because examination is nearing.
excuse me, sir. Sir, this off-balance sheet item, LC, BG, and other thing, when it will become it's on fund-based, sir. Can you please repeat? In case of default or something like that.
A bank guarantee. What is a bank guarantee? You tell me. If you know a bank guarantee, then you can. What is a bank guarantee?
It's a guarantee issued on behalf of the. It can be financial or a performance, sir.
Okay.
For
that is immaterial. How the bank guarantee is operated or issued, to whom it is issued, how it is issued, when it is issued, you tell me.
bank guarantee, like is one of our customer request for any performance related, like contract or something.
Okay. So the contract is in between whom? What is that contract?
In between
contract between your customer and whom?
And the
customer
bank.
with
bank.
Customer bank.
For other parties, other customer.
What is that other party? Say government.
It can be any beneficiary or government. Yes.
So that other party is the beneficiary. So
yes,
your customer has to do something, whether it is a performance or financial, whatever it may be. That contract is between a government or the contractor. Who that
yes,
contractor
sir,
is your customer. So this is the beneficiary, and this is your applicant of the bank guarantee. He is the customer of your bank. This is beneficiary. The contract of business is between government and customer. So when this, so suppose this is a contract of say performance guarantee. When government will ask for the payment from the customer or will terminate the contract?
after execution of the.
Suppose बीच में बंद कर दिया तो?
No, sir,
after execution, government will make the payment. Okay. So
yes,
here government will make the payment after doing the job completely. Entire thing is completely done as per terms and conditions. Then only government will pay to the contractor. If in between contractor छोड़ के भाग गया तो क्या करोगे?
Bank is liable to pay for on behalf of customer.
Why bank? Because customer has approached the bank to issue a bank guarantee. So bank guarantee will be issued on behalf of the applicant in favor of the beneficiary. So bank guarantee ka copy jo hai, that copy original will be kept with the government. If there is a default by the customer, the government will come to the bank so that आपने एक bank guarantee issue किया था, अभी customer भाग गया, now you pay me the money. So bank कहाँ से payment करेगा? ये तो paper है only. Bank guarantee is a paper guarantee letter that in case the customer defaults, I will pay you the amount. That is the promise given in the bank guarantee to the government. So bank कहाँ से payment करेगा? Where from bank will pay? Where from bank will pay? How
There
the
should
bank
be
is
some
going to
margin.
margin
There
after
should be some
100%.
margin, sir.
Okay, suppose margin पूरा नहीं है. Suppose this guarantee has been issued with say 20% margin. 100% margin है तो no problem. Suppose it is issued with 20% margin. So 80% you are having. 20% कहाँ से दोगे आप? Where from 20% will be given? What will do 20%? Government तो पूरा पैसा चाहेगा ना. Government wants the full money.
Yes, sir.
So how the bank is going to pay 20 rupees? Suppose 100 rupees का है, 80 रुपया आपके पास मार्जिन है, 20 रुपीस नहीं है, आज पेमेंट देना है, आप कहाँ से बोलोगे कि नहीं भाई गवर्नमेंट रुको, मैं कस्टमर से 20 रुपया लेके आपको दूंगा. कस्टमर तब तक भाग जाएगा वेस्ट इंडीज या लंदन. तो ये 20 रुपीस कहाँ से दोगे? So 20 rupees you have to create a loan. Bank will create a loan on behalf of the customer. Loan account will be created and then fund will be released. So 20 rupees is the loan which is becoming a funded asset. Now it is clear?
Okay. Yes, sir. Yes. Thank you so
अरे
much, sir.
अपने पास से
Actually,
pocket अपने पास से जब पॉकेट से पैसा देते हो ना, then the asset is created. That becomes your funded. जब तक पैसा नहीं जाता तब तक non funded है. Till the money has not gone from your pocket, from the bank's pocket, it is not funded. When for any reason there is a default by the counterparty, so here the counterparty is your customer, because you have issued the bank guarantee on behalf of the customer in the favor of government. So in that case, that amount has to be paid by debiting the loan account. That means you are creating an asset. So you are converting the non-funded into funded. Same rule applicable
Yes,
for all the things.
Sir, can you ask one more doubt regarding that fund and fund?
हाँ, बोलो पूछो.
जैसे कि सर in quarterly closing and all, suppose customers execute that bank guarantee or whatever, if we are not closing that particular, that is revoked to the bank, so it becomes liability to us, sir.
No, that's why liability means what? See, revoked by whom? Who revokes the guarantee? Who will revoke the guarantee? Who has the power to revoke the guarantee? Yeah, see, I have told you this is the bank or issuer. See, you have to understand the mechanism. Issuer,
yes, sir.
there are three parties. Issuer, there is applicant.
Applicant and beneficiary.
And there is beneficiary. Okay. Who will revoke the guarantee? Who has the power to revoke the guarantee? आपके घर में ताला लगा हुआ है. Your door is locked. Who can open the lock?
Applicant.
Who can open the lock? House owner or anybody who has the key, right?
Key, yes, sir. Yes.
So आपने अगर किसी फ्रेंड को की दिया तो वो खोल नहीं सकता, वो हाउस ओनर नहीं है. So those person who have the key, they can open. So here who has got the key to revoke the guarantee?
Banks.
Bank revoking the guarantee. Guarantee किसके पास है?
Applicant के पास.
Because you are totally confused. Totally confused. You do not know the mechanism. आपके पास फिक्स डिपॉजिट रहेगा, बैंक में आप किए हैं, आपका फिक्स डिपॉजिट आपके नाम में है, बैंक ये है, तो कौन जाके फिक्स डिपॉजिट को प्री मैच्योर कर पाएगा? आप करोगे या आपका ब्रांच मैनेजर जाके करेगा या आपका फ्रेंड जाके करेगा? कौन करेगा? Who has the right to receive the payment or make a premature payment of the fixed deposit? You are holding this. Who has the right? आपके पास right है ना? You have the right to close this fixed deposit. Yes or no? Because the fixed deposit is issued by the bank in favor of you. तो यहाँ पे बैंक गारंटी किसके फेवर में इश्यू हुआ है? किसके फेवर में? एप्लीकेंट के फेवर में.
बेनिफिशियरी.
गवर्नमेंट.
बेनिफिशियरी के फेवर में. एप्लीकेंट रिक्वेस्ट किया. आप अंग्रेजी भी नहीं समझते प्रॉपरली, इसलिए मैं हिंदी में बता रहा हूं आपको. सी, बैंक गारंटी इज ए गारंटी issued on on behalf of the applicant. So applicant, on behalf of the applicant, bank will issue in favor of beneficiary. So favor किसका है? Beneficiary. So beneficiary has a right to revoke. उसके पास original bank guarantee होता है. So he will place the guarantee to the bank. Then only it is a revocation. That means he is asking money by giving the bank guarantee, जिसमें लिखा होता है कि बैंक बोलता है, promise करता है, bank is promising that when the original bank guarantee is submitted to me, it will be considered as revocation of the guarantee and we will make the payment as per the terms and condition of the guarantee. Simple. आपने कभी पढ़ा नहीं बैंक गारंटी को, आप अगर पढ़ते तो बैंक गारंटी जब बैंक ब्रांच में इशू करता तो आपको ये डाउट नहीं होता. Normally, what is our mistake? We never go through any document, any of the circular, any of the bank guarantee, whatever issued. We don't have interest in exploring those. Only to pass our examination, we want to understand. That is not going to be a good thing. You cannot become a good asset to the bank. You will become a good asset when you want to explore yourself, to know everything, to read every circular. It will be clear for you. Okay, have you understood the concept now? Now
Yes,
tell
sir,
me
yes.
what was. Now tell me what was your question? Revocation का बात किया था आपने.
No.
What is the question? You tell me.
नहीं, during sir
Closing. आपने पूछा था
quarterly and
during the closing. What is the position? You tell me. What are your
normally
questions?
वो
in
लोग
closing?
after
Normally?
execution of the bank guarantee.
हाँ
Sorry.
हाँ bank guarantee.
Well, bank has to reverse that guarantee. Sometimes you do that liability portion, you have to make zero. होने के बाद वो करना चाहिए ना, like applicant has to request
So
to
that
close the
is
guarantee.
see, only when it is revoked by, then it will be closed. Okay. Otherwise,
Yes, sir, yes.
you are still confused. At the
No,
time
no,
of
in
closing,
practical, sir, in practical, beneficiary is not giving that revocation and all. Applicant is
हाँ,
telling
that-
this has to be.
so normally what happens? Normally at the time of closing, these are the only book entries you are passed. Because you want
Yes,
to
sir, yes.
clear your contingent liability of balance sheet item.
Yes, yes.
So
yes,
एक दिन
yes,
के
sir.
लिए आप उसको नील करते हो, नेक्स्ट डे आप फिर से उसको रिवर्स करते हो.
That practical expert I was not getting. That's why I asked, sir.
So that is only book entry, that does not have any relevance. So don't worry about those things. So that is
Thank you
only
so
book
much.
entry. Okay.
Uh,
Any other question, or I'll say goodbye today. Tomorrow we'll meet again.
Sir,
Tomorrow?
excuse me.
First.
Sir, regarding Tier 1 and Tier 2 capital, sir, a small doubt, sir.
You have already attended my class?
Yes, sir. Yes, sir.
Oh, okay. What is your question? You tell me.
Here the revaluation reserve, regarding revaluation reserve, if in question, if asked that 220 crores is the revaluation reserve, we have to
Okay.
take 55% or 45% of the value.
So this is 55% discount.
Yes,
Suppose you are going to purchase a shirt where it is written 1000 rupees is the price. They will give you 55% discount. So what will be the price you are going to pay? This is the discount rate.
450.
450.
450. That means how much you are paying? 45%. Na?
Yes, sir. In
So
answer
that is
to
it. If the discount is 55%, means you have to take 45% of 220. That will be the value of this revaluation reserve in Tier 1 capital.
Okay, sir.
Okay.
Sir, and Tier 2, 1.25% of total risk weight assets. We are taking that minimum of the 1.25% of risk weight assets or contingency liability they have given that will we have to take, sir.
Now, where contingent liability come? This you are talking about the Tier 2 capital, where this provision 1.25% is coming for general provisions. General provision. If there was some provision, general provision, like if a item will be taken as a provision for standard asset. Provision of standard asset is a 300. So how much you can take? So this is restricted to 1.25% of the, how much? 1.25% of the total credit risk weight asset, not total risk weight asset.
Okay, whichever is minimum we have to take, sir.
Always, whichever is the minimum only. Always it is mean 300 you cannot take. Suppose your credit risk weight asset is say 1,000 or 10,000. 10,000 is the credit risk weight asset. So 10,000's 1.25% is how much?
13.5.
125.
125. Okay. So how much you take? 125 or 300, whichever is lower. Okay.
Oh, okay, sir.
Okay. Suppose it is say 1 lakh, then 1.25% of 1 lakh becomes 1250. So 1250 is higher. So in that case, you have to take 300 only. Whichever is lower, you have to take.
Okay, sir. Standard assets. Okay. Okay, sir. Thank you, sir.
Okay.
Thank you so much, sir.
Okay, welcome. See you tomorrow.